Okay, so hello everybody. I'm Penelope Allard from Wild Bookkeeping. I've been running my practice since 2009 as a sole trader, and then we incorporated and became Wild Bookkeeping 4 years ago. We've won 3 national awards from the Institute of Certified Bookkeepers, and we've twice been a finalist for the Accounting Excellence Awards. And this year we were a finalist in the ESG category, recognising the work that we're doing with charities and in the community as well. And for sustainability. So that's a little bit about us. Today's topic, from passion to paperwork, CIC or charity finances don't have to be scary. This underscores an important point. It doesn't matter how passionate or effective your organisation is. If you don't get the finances right, then things can go very wrong. I've worked with many CICs and charities on their finances, and I've seen the same avoidable problems popping up over and over again. So in this webinar, I'm going to share the most common financial mistakes that CICs and charities make, and more importantly, how to fix them before they become expensive headaches. This session is going to be practical and jargon-free. You don't need to be an accountant to follow along. My goal is that you leave with a clear action plan to get your organisation's finances in order and keep them that way, so that you can focus on your real mission. We're going to cover 5 key areas where well-meaning organisations often trip up, from paying people correctly, to handling funds and grants, to using the right tools, to meeting your annual legal requirements. So this session's ideal for anyone that's running or setting up a CIC or a charity, whether you're new to this or have been at it for years and want a refresher on best practices. And at the end of the session, we'll have a Q&A session, so do feel free to jot down any notes or questions that you have as we go along. So let's get started. We're going to start with a brief introduction to set the scene. Basically, why getting your financial setup right is so crucial for CICs and charities. And then we're going to dive into 5 main topics. We're going to talk about payroll essentials, how to pay yourself and your team in a CIC or a charity, and specifically why directors can't invoice their own CIC as if they were external consultants, and how to set up proper payroll. This is a common misunderstanding that we're going to clear up. We're going to talk about restricted funds, what those are. It's money that must be used for a specific purpose and why that matters. You'll learn how to manage those funds so you don't accidentally misuse them, because that can get you into legal trouble. We're going to talk about deferred income. So that's grants that are going to cover more than one financial year. We'll look at how to account for a grant intended for next year's activities, when you need to recognise the income, and when you need to defer it to avoid a misleading surplus or deficit. It's a bit of accounting know-how that's going to help you to keep your books accurate. We'll cover software and systems. I know many small organisations start with spreadsheets, so we're going to discuss moving away from error-prone spreadsheets and setting up proper accounting tools that will save you time and reduce stress. Don't worry, we'll keep it simple and suggest affordable options. Annual reporting. Every year, CICs and charities have reports and filings to do. We'll cover what those filings are, things like your CIC 34 community interest report, what a registered charity needs to do, so annual return, trustee report, etc., and key deadlines and requirements so that you stay compliant. At the end, we'll wrap up the session with key takeaways and have a Q&A. So this is an ideal time to get clarity on any issues that you're facing. So let's dive into our first topic, payroll essentials. So our first topic, payroll essentials, the big message here is if you're a director of a CIC or a charity, you cannot just invoice your own organisation for the work that you do as a director. This is a mistake I see time and time again. Very often you set up a CIC because you've been operating as a sole trader, and then you realise that you could get funding and do some real good in the community if you're a CIC. So you set your CIC up and you carry on invoicing the CIC as your sole trader. You just can't do that. So in the UK, HMRC considers company directors to be office holders, which basically is a fancy way of saying that you're treated like an employee of your own company for tax purposes. This means that any money you receive for performing your role as a director must be treated as employment income and go through the PAYE system with tax and national insurance deducted. I've seen people make this mistake so many times, paying themselves and sending an invoice to their CIC as though they're an outside contractor or a consultant. You certainly can't do that for your core duties as a director. So in terms of running the business, the management of the business, that's a definite no-no. HMRC will say, nope, that's a salary, and they will expect income tax and national insurance to have been paid. If you don't do that, it could lead to a nasty surprise. And I have seen this happen. HMRC will come back and they will say the money that you've paid is your net pay, and they will expect your organisation to pay the tax and national insurance on top of that should have been deducted. So that could lead to a nasty surprise, backdated bills, interest on the missing payments, possibly penalties as well for not doing it right. It's a really quick way to get on the bad side of HMRC and drain your charity's funds with fines. So what's the correct approach? What you need to do is set up a payroll and put yourself and any staff on that payroll. So you'll need to log on to HMRC and register your CIC or your charity as an employer. If you're a CIC, that's relatively easy to do. You can do it straight through the HMRC website. If you're a charity, there's an extra form that you have to do and notify them in writing. It takes a little bit longer. So you register with HMRC as an employer, and then every time you pay yourself or anybody else, the right taxes are withheld and paid over to HMRC. There are lots of affordable payroll software options that you can use for doing this. You can use the HMRC basic PAYE tools, which is completely free. And that's great if you've got a really simple setup. The key is that the money that you take out for work is reported like a salary. If you don't want to use the HMRC basic tools, there are other softwares out there. Fresh Pay is a really good one that's inexpensive and very easy to use. There are others, there's MoneySoft, BrightPay, but Fresh Pay in particular, if you don't have very many employees or if it's just you on your own, is really ideal. So you might wonder, is there ever a time that you can invoice your own organisation? Well, there is a really rare exception, and that's if you're doing a completely separate type of work for your organisation that isn't part of your director role. So if you're acting as a true independent contractor in a different capacity. So say, for example, your CIC runs a community centre and you happen to be a qualified electrician and you do some electrical installation work for a new project. In theory, you could invoice for that specific service because it's not what you do as a director day to day. But even in that case, you need to be really careful. You need to document that arrangement. You need to make sure that the other board members approve it because there's potentially a conflict of interest there. You need to make sure that you're being paid at a fair market rate. And HMRC will scrutinise these situations very closely. So the general advice really is to avoid such arrangements or keep them to a minimum. The safest rule of thumb is that any payment for your work as a director or a key person goes through payroll. This keeps everything above board. It looks more transparent to funders and stakeholders. And it's clear that you're not trying to do anything fishy. You're just drawing an appropriate salary for your work. If you haven't already, get your PAYE sorted out. Even if you're the only person working in your CIC, you still need to run a payroll for yourself. If you're only taking expenses or a very small stipend, make sure that that's documented properly. The good news is that once you've got your payroll set up, it becomes routine and you'll have peace of mind that HMRC won't come knocking about how you pay yourself. So in short, don't pay yourself by invoice, pay yourself using payroll. It's one of the big foundational steps which can avoid a huge financial tangle later on. Our second topic is restricted funds. Simply put, a restricted fund is money that a donor or a grant maker has given to you for a particular purpose, and you are legally obligated to use it for that purpose only. For example, if you receive £5,000 to run an arts programme for underprivileged youth, those £5,000 are restricted to that programme. You can't decide later to spend part of that money on a new computer for the office or on a different project. In contrast, unrestricted funds are funds that you can use for any of your organisation's objectives, like general donations with no strings attached, or fundraising income from a bake sale that goes into your general pot. So why is managing restricted funds so important? It's because if you use a restricted fund for the wrong purpose, you are effectively breaking a legal promise. The Charity Commission, the regulator for charities in England and Wales, treats misusing restricted funds as a serious breach of trust by the trustees. It counts as mismanagement or misconduct. In the worst case, your organisation could be investigated, and trustees could even be held personally responsible to repay the money. If you're a CIC and not a registered charity, misusing funds will destroy trust with your funders and could jeopardise future grants or donations. Funders often ask for reports on how their money was spent, and you need to show it went to the intended purpose. So how do we avoid accidentally misusing restricted funds? The key is in segregation and tracking. The moment you receive restricted income, earmark it in your accounts. If you're using accounting software, create a separate fund or a project code for that money. If you're using spreadsheets, which, as we'll discuss later, has its own challenges, you might keep a separate column or a sheet that tracks that fund. The idea is that at any given time, you should be able to say, we received X pounds for this specific purpose, we've spent Y pounds on that purpose so far, and Z remains dedicated to that purpose. Importantly, don't mix restricted funds with your general bank for spending. This doesn't necessarily mean you've got to keep a separate bank account for each fund, although some organisations do that for clarity. And a lot of bank accounts now will enable you to have pots so that you can keep money in separate pots. What it means is that in your record keeping, you treat that money as untouchable for anything else. A good practice is to have a policy like, we will not use restricted funds to cover shortfalls in other areas. Sometimes when cash is tight, people are tempted to borrow from a restricted pot. We'll use a bit of that grant money to pay this bill and we'll put it back later when the fundraising comes in. This is a really slippery slope. Avoid it unless you formally get the donor's permission. Using restricted money for something else without permission is not allowed. If you really haven't got any choice, contact your funder and get written consent for a budget reallocation. Or if the funder no longer exists, potentially seek permission from the Charities Commission. But that's quite complex, and really that's a last resort. Transparency is also vital. In your annual accounts, you need to report on restricted funds separately. Charities, for example, will show a column for restricted fund in their statement of financial activities and include notes detailing each restricted fund. So Fund A received 5k and spent 3k on the project, 2k carried forward to next year. Even if you run a CIC and produce simpler accounts, it's good practice to include a note about any restricted grants that you have, indicating that you're carrying unspent portions forward for that purpose. That level of detail shows supporters and regulators that you are a trustworthy steward of donated funds. Make sure that everybody on your team or board understands what restricted funds are. Often it's a knowledge gap. You might know as the director or the finance person, but perhaps another trustee doesn't realise and approves spending that inadvertently dips into the restricted money. Educate your colleagues, label those funds clearly in your reports, talk about them in meetings. Remember that 5k is locked in for the Youth Arts Project. So in summary, treat restricted funds with care. Keep them separate in your planning and accounting. Use them only for your intended purpose and be transparent about their use. This way, you'll honour the commitments made to funders and avoid those serious breaches of trust. The third topic is deferred income, which is about the timing of when you recognise income, especially grants in your accounts. This might sound a bit technical, but it's very important for giving a true picture of your organisation's finances. Imagine this scenario. It's December, and your charity's financial year ends on the 31st of December. You receive a grant of £20,000 in December that's explicitly to cover a project that will run through 2026. If you just follow the cash basis, it looks like you got 20k income in 2025, making 2025 appear very healthy, maybe in surplus. And then in 2026, you'll have all the expenses but no income because you've reported it in the previous year. And then you'll show a big deficit. That distorts the reality, because in reality, that 20k wasn't meant for 2025's work. It was meant for 2026. So on this note, if you are a CIC is a form of limited company. And as a limited company, you are legally required to use what's called accruals accounting. That means your income and your expenditure has to be reported in the period to which it relates. It doesn't get reported on the timing coming in and out of your bank account. So I've seen a lot of people who will run a CIC using spreadsheets. They'll take a download or a CSV file of their bank account, and they'll do their accounts on the basis of the money in and out of their bank account. That is not correct. If you're a CIC, you need to be doing accruals accounting, which is really hard to do on a spreadsheet. If you're a charity and a small charity, you are allowed to do cash accounting. I wouldn't advise it because it's not giving you a true picture of your income and expenditure and where it belongs. So deferred income is an accounting tool that lets us handle this. Deferred income means that you record the money that you got in advance as a liability, so something that you owe, so you'll see it on your balance sheet, rather than as immediate income. So why is it a liability when it's money that you've received? Think about it in the sense that you owe your funder the delivery of the project. So they've given you that money, but you haven't yet delivered the project. So you either have to deliver the project or pay the money back. So that's why it's a liability. So at the end of December 2025, instead of showing £20,000 income, you would show £20,000 on your balance sheet under deferred income. So this is a line that essentially says you've received that money in advance. Then in 2026, when you carry out the project, you release that deferred income onto your income statement and match it with the expenses. So your income and your expenses are both in the same year, which means that it's going to make more sense, isn't it, as to whether you have or haven't made money. So according to the UK accounting rules, you defer the income only if there are conditions that mean you're not yet entitled to treat the money as yours. So it's not that you haven't used the money, it's whether you can treat the money as yours. So a common condition is time-based. Your grant letter might say this funding is for activities between the 1st of January and the 31st of December 2026. That tells you that you can't count that as income in 2025. It's meant for 2026. Another condition could be performance-based. So they might say, we'll give you £10,000, but if you don't achieve X by June, you'll have to return the unspent portion. In that case, you might defer the portion that you're not sure about until you meet that condition. So when shouldn't you defer? If the grant or the donation is essentially yours with no strings attached to it, beyond use it for this purpose, then even if you haven't spent it by year end, you generally have to recognise it as income now. You show any unspent part of that fund, carrying it into next year, but you wouldn't label it as a liability. The accounting principle is you receive the income, you're entitled to it, so it's income. The fact that you haven't spent it yet doesn't matter. That's a separate issue of how the resources get carried forward. So you can't defer income just because you haven't spent it. And that's an important point if you're a CIC, because you're going to have to pay corporation tax on any profits that you've made. So if you've got money and you haven't spent it, you're potentially going to have to pay tax on it. So a lot of small charities think, we've got 50k, we've only spent 30k. Let's just show the 30k as income and defer the other 20. But if that 50k was fully yours with no conditions to fulfill to keep it, you have to show that 50k income. And then the 20k in the bank, which is probably earmarked for a fund for next year, just shows as funds to be carried forward. It's only if there is a condition or a specific time restriction not to spend it before a certain date that you're allowed to defer it. So this is really important. We want our financial statements and our accounts to reflect the reality so that we can be compliant with accounting standards. If you don't defer when you should, you might think you've got more disposable income than you've actually got, and that could lead to you overspending and not being able to deliver those projects further down the line. But if you defer it when you shouldn't, then you might underreport and it would make your charity or your CIC look poorer or at risk when it isn't. So for your own planning and your transparency, it's really good to match the income with the period of activity it's funding. And funders will also appreciate that clarity. If they give you multi-year money, they want to see that you're carrying it forward correctly. So if your CIC gets £60,000 grant in July 2025, and it's going to run a programme from July 25 to June 26, so that's 12 months, and maybe it's spanning over two financial years. If your year end is December 31st, you would need to put half of that grant money from July to December 25, so £30,000 would come in as income then. And then the remaining 30,000 gets deferred into 2026 and released into income then. So that way, the income and expenditure is matched in the correct year. So what I want you to do when you've finished this webinar is to go back, look at each of your major grants that you've received and check the terms. If it clearly states that it's for next year or it's got conditions, then set up a deferred income entry at year end for any of the unearned portion. Or make sure that your accountant or bookkeeper is aware of those terms. It's a common area of confusion, but doing it right means that anyone reading your accounts, so that's trustees, regulators, donors, can see that you didn't actually run a huge surplus, you just received the funds early for next year's work. So in summary, defer the income when it's not yet earned or entitled, usually due to time or performance conditions, and don't defer them if it's just unrestricted gift that just gets carried forward. And that will keep your financial reporting honest and clear. So all of that needs a system to be able to record those figures correctly. And that's our fourth topic, the tools that you use to manage your finances. Many small charities and CICs start out managing their books on Excel or Google Sheets. That's understandable. It's readily available. It feels straightforward for a small number of transactions. As your organisation grows and your finances get more complex, relying solely on spreadsheets can become a liability. So what's wrong with spreadsheets? Well, for starters, they're error prone. You can easily type in a figure the wrong way round, get a decimal point in the wrong place, 6s and 8s get muddled up, put things back to front. So it's easy to do that. It's easy to mess up a formula. And often there are no automatic checks in place to catch those errors. So a review of charity accounts found that a lot of common mistakes were due to manual processes in Word and Excel. Errors that are easy to make and hard to catch. For example, you might update one sheet that you're using to track a particular restricted fund and then forget to update another sheet, so you've got inconsistencies. Maybe your total funds don't match between the two reports. Also, as more people get involved, version control becomes a bit of a nightmare. Who's got the latest spreadsheet? Did you overwrite something? And it can be really time consuming to produce those reports each time you need to do a finance report to the board. You can spend hours collating data and making charts in Excel. If you're using accounting software though, and there are several affordable options and potentially even some free options coming, this can give you an ideal solution. So things like QuickBooks or Xero are really popular commercial softwares, and they often offer discounts for non-profits. Xero certainly does. Free Agent at the moment doesn't offer tracking categories, so it's not suitable for charities and CICs, but I'm reliably informed that that's coming really soon. And if you bank with NatWest, then you can have a Free Agent account for free. The beauty of these systems is they handle double entry bookkeeping behind the scenes. So double entry bookkeeping is where we show, for example, if you're paying for something, you'd have a movement on the bank account, which is on the balance sheet. And on the other side of that, you'd have the expense recorded on your profit and loss. And because you've got to have these double entry going in, your books have to stay balanced. You don't get those errors where things don't add up. Software usually has a bank feed in, meaning it connects to your bank account and it will pull those transactions in daily. This means that you're not having to retype those figures from your bank statement or import them. Bank feeds are really great. They're secure. They use open API, where the information gets pushed from the bank into the software. So it's safe to use. It means you've got accurate, up-to-date figures. Most bank accounts these days will connect to the software. Metro Bank, you'll have to write to them and ask permission. CAF Bank does connect to QuickBooks. It won't connect to Xero at the moment. So there's a few things it's worth checking on. But generally speaking, if your bank will connect to your software, you should connect it. And then all you have to do is you categorize each line that it pulls through. So you can say this £50 was fundraising income, that £30 was stationery expense. You can set up rules to automatically categorize things, making it quicker to do. And the huge advantage is reporting. If you want to see a profit and loss statement for the last 2 months or for a particular restricted fund, 2 clicks and it's there. If you're using tracking categories for your projects, it's really straightforward. And when it comes to your year-end accounts, again, the software will generate the trial balance for you and basic statements, which your bookkeeper and accountant can then turn into compliant accounts for you to submit. Think as well about making tax digital. If you're VAT registered, then you'll need to keep digital records and file VAT returns through software. Now, most grant income doesn't count as VATable turnover, but it is something that's worth checking. So if your income gets to £90,000, you are potentially needing to register for VAT. And I would recommend consulting a VAT expert to get that clarified if you're not sure, because if you get it wrong, it can be very, very expensive. So Excel alone doesn't meet that condition that you need for VAT registration. You need to be using software. So how do you switch over to software? It might sound really daunting, but generally speaking, it's a one-off project and it's going to pay off really quickly. So this is how you might approach it. Pick a slow period or year end to make the switch. You don't want to do it when you're really busy because it is a lot of work. You need to switch onto the software at year end. Don't try to do it mid-year. If you're doing it mid-year, then you're going to need to backdate it to the beginning of that financial year. You want the whole of one financial year on that software. The first thing you need to do is look at your chart of accounts. So your chart of accounts is the list of all the different categories that you want to use. That's really important when you're setting up these categories. You don't want to have too many categories because that's going to make it really confusing. But equally, you need enough that is going to enable you to analyze things out. So, for example, don't put one down that just says volunteer, or you might have volunteer expenses, but say you've got travel and you're using contractors to come in and do work for you. You want to be able to break down the contractor costs and their travel costs. But you don't need to have two separate, or three different codes for travel. Travel is travel. Think about where you're duplicating things. So look and think, is this a particular cost that I want to track and I want to monitor? If it is, put it into that cost code. If it's a cost that's going to then be broken out by tracking categories, by your different projects, that's fine. You only need to have it once because you're going to record it against project expenditure and then each of the separate projects. So think carefully about your chart of accounts and what information that you're going to get from it. Try not to have codes that are too similar and are going to be confusing. Then you're going to input your opening balances. So whatever your balances were at the end of your last financial year, that's what you're going to put in. And again, whoever's produced your year-end accounts will be able to provide you with those figures. This then means that you've got continuity and you can compare one year with the next. Once you've got that set up, link your bank feed. So you set up your bank account in your software, you'll enter your login and your password to your bank, and that will pull through all the data from your bank. Just make sure you've done it from the correct date. You want to backdate that bank feed to the start of your financial year. Then spend a bit of time learning the software. So most of the software providers have excellent online tutorials or free webinars for beginners. Your bookkeeper or accountant as well, they may be able to offer you some training on that as well. Look at your invoice templates. If you're invoicing donors or trading income, get your invoice template set up correctly, and then set budgets in your software as well. So something that's really useful is you can actually put a budget in, and then you can measure where your actuals are compared with your budget. So the benefits of using software: you're going to reduce your mistakes because the software isn't going to let you put in one half of the entry and not the other. You're going to save time because your bank is going to be pulled through automatically. And you can generate really polished reports for your board and your stakeholders. Another benefit is that you'll have an audit trail. So each person using your software should have their own login. You shouldn't be sharing logins. And this means you can have a look and you can see exactly who's done any of the transactions in your reporting, something that you wouldn't have on a spreadsheet. You can also attach copies of your receipts to each entry so that you're not having to worry about losing paper receipts or digging through filing cabinets. I would really recommend using an app that you can attach to the software. So we use Apron, and that means that you just take a photograph on your phone, WhatsApp that photograph through, and it's automatically in your software. So it's a good way then of keeping your records. So we've transitioned a number of small charities onto software, and usually they say to us, why didn't we do this sooner? It takes a little while to get comfortable, and it's a bit painful when you're, getting that backlog on. But once you've done it and you're up to date and you're scanning those things in regularly, you're going to have up-to-date information, and jobs like preparing your end of year accounts or working out who owes you money is just going to take minutes. Another thing to mention is security and backups. So bit topical this week because we had an AWS outage on Monday, meaning that nobody could get into Xero. However, within a few hours, it was back. Cloud software, generally speaking, is very secure, and it backs up your data automatically to a number of data centers. Make sure you use strong passwords. Always put on two-factor authentication. I know it's annoying having to put that code in from your phone every time, but that means that it's really secure. And it's actually safer than having everything on one person's laptop on an Excel file, because that file could get lost or corrupted, or the laptop could be stolen. So in conclusion, invest some time and proper accounting systems as soon as it's feasible. I know Xero is £37 a month, but actually if you consider the time that you're saving yourself and the accuracy that you're going to get, it's soon going to pay for itself. You're going to have reduced errors, less stress, more professional looking financial management. And as you grow, funders and regulators like to see that you've got robust systems. It's a sign that you're taking the organisation's governance seriously. You're not running it on sticky notes and hope. So to avoid the tangle of chaotic bookkeeping, get those systems in place sooner rather than later. Finally, let's talk about annual reporting, the things that you need to do every year to stay compliant with the regulators for your CIC or charity. This is where having those good systems and practices we discussed really pays off, because chaotic organisation might dread year end, whereas an organised one will handle it smoothly. For CICs, because the CIC is a type of limited company, you have to file annual accounts with Companies House. Usually, small CICs can file simplified smaller companies accounts, often called micro-entity or abridged accounts, unless you choose to file full accounts. In addition to those, every CIC has to file a CIC 34 form each year. This is your community interest company report. Essentially, the CIC 34 is a short report where you answer questions about how you continued to meet the community interest test, what activities you did to benefit the community, how you involved your stakeholders, and details of any assets or dividends to ensure that you obeyed the asset lock and dividend cap. So most CICs can't pay out dividends. The only way of getting money out is via payroll. But if you have got the option in there to pay out dividends, this is where you need to report it. It's usually a form that you fill out and submit alongside the accounts. The deadline for your CIC accounts and for your CIC 34 is 9 months after the end of your financial year. So if your financial year end is the 31st of March, you need to file by the 31st of December that year. If it's your first year, sometimes you get a little bit longer, up to 21 months for incorporation, but thereafter it's 9 months. And also note, when filing the CIC 34 in the accounts, there is a filing fee to Companies House that you'd need to pay as well. Every year, you also need to complete your confirmation statement. So every limited company and every CIC has to file a confirmation statement, which is due within 14 days of the anniversary of the last one. That's just confirming your basic details, your directors, your registered office. But it's important because if you don't do it, you can get struck off. If you're a registered charity, then you have to prepare accounts and a trustee's annual report, even if you're really small. And if you don't send them in, you still have to have them available. If your income is over £10,000, then you need to file an annual return with the Charities Commission within 10 months of your year end. Your annual return is typically an online form, and for charities above 25,000, it includes submitting your accounts and the trustees report. If you're below 10,000, you don't file a full return, just an annual update, but you still need to keep those documents. If you're a CIO, you have to file every year regardless of your size. The trustees' annual report is the narrative where you explain what your charity did over the year, successes, finances, and telling your story, confirming you delivered public benefit. Regarding external scrutiny, if your income is over 25,000, then you have to undergo an independent examination, which is a lighter touch check by an independent person, often an accountant or experienced volunteer, to ensure that your accounts are reasonable and follow guidelines. If your income exceeds $1 million, or you're between 250k and $1 million with assets over 3.26 million, then you'll need a full audit by a qualified auditor. These thresholds are set by charity law. An independent examination is simpler and cheaper than audit, and it still provides assurance. So keep those thresholds in mind as you grow. CICs, on the other hand, follow normal company audit thresholds, very high for small ones, so 10.2 million. So most CICs won't need an audit by law, but some funders might want you to have an external review anyway. So why does timely and accurate reporting matter? Well, for one, Companies House will fine you if you get it wrong and if you're late. And those fines can start at £150 for a private company and escalate to £1,500 if you're more than 6 months late. And that's money that could have funded your programs instead. The Charities Commission doesn't fine for late filing, but if you're late, they'll flag your charity as overdue on the public register, which donors and funders can see. It looks bad, and if you're habitually late, the Commission can open a compliance case against you, or worst case, remove you from the register. Also remember that your filings are public. CIC accounts and your reports are publicly available via Companies House, and the Charities Commission publishes charity reports too. This is actually a really good opportunity for you. A well-crafted Charities Annual Report, or CIC 34, can demonstrate your impact to your potential supporters. It's not just a dry compliance document, it's your chance to show off what you've accomplished with the funds that you've had. If you submit something that's incomplete or with errors, or people see that you're always late, then it will undermine confidence. And from a grant maker's perspective, they often check with the Charities Commission or Companies House to see if your organisation is well run. So best practice, mark the key dates right now. So if your year end is 31st of March, diarise the 31st of December, 9 months later, as the deadline for Companies House, and 31st of January for Charities Commission. Better still, aim to finish your accounts and your reports well before those deadlines, at least within 6 months. That way, you've got a buffer if anything needs more work. Engage your board in approving those accounts. Have a meeting for it. It's good governance. Get things signed off early. If you're both a charity and a company, then you'll have to file with both the Charities Commission and Companies House. But this is unusual, particularly if you're a CIC. So celebrate your achievements, be honest about your challenges, including the financial ones, and show that you have a handle on governance. Mention that you've got a reserves policy or that you keep restricted funds separate, things that we've been discussing. Those all demonstrate good financial management. So know your specific obligations, CIC versus charity, mark your deadlines, treat annual reporting not as a chore, but as an integral part of running an incredible organisation. With timely and transparent reports, you'll stay out of trouble and you'll strengthen your reputation. So we've covered a lot of ground. So let's recap those 5 key takeaways from today's session. Payroll essentials, pay the right way. Make sure you're paying people, especially your directors from your CIC and your charity, correctly. That means no self-invoicing for director duties. Use the PAYE system. It might be tempting to call yourself a consultant to your own organisation, but HMRC has made it clear that directors are office holders and need to be on payroll. Getting this right from the start will save you tax troubles and show that you handle compensation properly. Restricted funds. Respect the purpose. Whenever you receive funds that are restricted to a particular use, treat them with extra care. Don't mix them with your general pot or use them for something else, just this once. Keep a clear record of what's restricted and stick to it. If you spend restricted funds incorrectly, even by accident, it's a big problem. Essentially, a breach of trust and potentially illegal. The fix is simple. Track it separately, and if in doubt, don't touch it for anything outside its purpose. Deferred income, match income with when it's earned. For grants or fees that cover future periods, use deferred income to carry what's unearned into the next year. This way, your accounts will show income in the year you deliver the service or the project, which is the proper way to do it. Don't simply defer income just because you haven't spent it. Only do it when the terms of the funding require it, like time restrictions. This keeps your financial story accurate and avoids confusion over big surpluses or deficits. Software and systems. Work smarter. If you're still using Excel or manual methods for your accounts and it's getting complicated, take the leap into accounting software. It drastically reduces human error and will save you time. Even free or low-cost tools can be a huge improvement. When your finances are streamlined and automated where possible, you free up your time and your brain power for your mission-focused work. You're less likely to tear your hair out at audit time or when preparing your reports. When you're preparing your reports, be timely. Use it to shine. Every year, you've got certain filings to complete. Know what those are. Note the deadlines down. Prepare early. And when you do file, make it count. Use your reports to show what you've achieved and that you're running a tight ship administratively. It's an opportunity to reinforce trust with your supporters, not just a box to tick. If you focus on these 5 areas, you'll avoid the most common pitfalls that trip us up. It boils down to play by the rules, keep good records, and be proactive with managing your reporting and your finances. With these practices in place, you can put your energy back into why you started your CIC or charity in the first place, passion and purpose, without getting tangled in avoidable financial problems. So thank you for listening. I hope these insights help you to keep your CIC or your charity's finances running smoothly so that you can fully focus on your passion and your purpose. I'd love to open it up for discussions. And if you want to follow us or get more information, we have a weekly newsletter, which you can access with the QR code. And we've also got a free Facebook group, which you're welcome to join, the Wild Bookkeeping Club. You don't have to be a client to be part of that, and it's a safe space where you can ask any questions.